Welcome to the Economics Explored podcast. I'm your host, Gene Tunney. I'm a professional economist based in Brisbane, Australia, and I'm a former Australian Treasury official. This is episode 89 on inflation. My guest today is a returning guest. It's Darren Brady Nelson. Darren, good to have you back on the program.
Thank you. And I'm also a former Treasury official, but an unprofessional economist nowadays.
Righto, yes. You used to work in the New South Wales Treasury. You've also...
I did, yeah.
Currently, you're at Liberty Works. You're chief economist at an Australian think tank, and you're also a policy advisor to Heartland Institute, if that's right.
Yeah, that's correct.
Good one. Darren, I thought it'd be good to have you back on the program. So this is your 8th appearance, if I'm counting correctly. And I thought it'd be good to chat about inflation because it's very topical at the moment. So we're recording this on the 22nd of May in Australia. So that's a Saturday morning here. And Darren, you're in Milwaukee in Wisconsin, USA, and it's Friday the 21st. So I'll just point that out just in case. Often data can change. We can get new data by the time this comes out, but I'll try and publish it reasonably soon. Okay,
you think
Darren,
our inflation worries might be over with by next week, so you better get it out, eh?
All right. Righto, we'll see. Okay. That's a good point. I think this is one of those issues that will continue for months to come. Okay, so Darren, you've recently authored an article, The Inflation Iceberg Beneath the Economic Waves of CPI. And I'll just read the intro from the article and then I'll ask you about the article. On May 12th, there was finally some of that much talked about unity in the country. So this is the US. However, unity, like everything else in life, has to be judged from a perspective of good or bad. This unity came from both left and right-leaning news outlets. It was good in that they all agreed that something bad just happened. It was also bad in that something bad just happened. That bad something was the 4.2% jump in inflation in April as measured by the Consumer Price Index, CPI, from the Bureau of Labour Statistics, BLS. This can clearly be seen in, you point to a chart that shows the increase in CPI. Okay, so Darren, this increase in CPI, to what extent was that just a recovery from the COVID recession? So some of the commentators on the left, on the progressive news sites, they pointed out, well, nothing to worry about here because we had a fall in CPI during the COVID recession, and then this is just CPI recovering to where it would otherwise be. What do you think about that argument?
Yeah, well, I think if you look at not just obviously what typically happens is where, for instance, I got this chart that I referred to in my article, and I essentially refer to 4 different charts, 2 on CPI and 2 on money supply, which we'll talk about in soonish, I imagine. So the first chart I referred to is just the 12 months, and even with that, that the argument that you're referring to doesn't hold water, because CPI was kind of going up with some of the stimulus that was going on under the Trump administration, but then it was starting to come back down. And then what changed is a change of administrations, and pretty much from the beginning of that change of administration. So you'd have to be looking at February, because obviously, although certainly the new administration, like the previous administration, got to work quickly, from January 20th onwards. But obviously there's a lag in things starting to show up in statistics. So with the new sort of Treasury officials, even though the Federal Reserve is nominally independent, these central banks are never completely independent from the political administrations. I call them semi-independent, really. And so you can see CPI starts going up, for instance, the rate of CPI, I should say, as opposed to, the straight index, starts out with sort of 1.4, was kind of flatlining around 1.4 or less. And then come February goes up a little bit, 1.7, goes up a fair bit more, 2.6 in March, and then obviously the headline figure of 4.2 in April. So even just looking, the 12-month basis, that narrative that some sort of progressive commentators have isn't correct. And obviously, if you look at, in my article, I show some more context, and I show, CPI as far back as I can get it, which is, essentially for the 1960s onwards. And even looking at the past sort of, 4 years, 8 years, you can see things are ticking up a little bit, even by, and frankly, it hasn't looked good under many administrations, going back to the late 1970s, or at least sort of, probably the late 1970s. So that's a very long answer to your question. There is something going on that's not really just COVID recovery or something seasonal.
Righto. So you mentioned the Federal Reserve before, and you argued, well, in a way, it is an arm of the US government, and it's certainly been involved in the COVID policy response in terms of lending money to businesses, like creating new money, lending that out. It's also been doing some quantitative easing, hasn't it, with the bond purchases. So the Federal Reserve has been massively increasing the money supply. Is this one of the things you're concerned about?
Yeah, so that's essentially the crux of my article is like linking the measure of prices of CPI, and that's only one measure of prices. And look, it's okay. It certainly has a reasonable amount of flaws to it. But my article isn't about the flaws of CPI. It's just going, look, here's this measure of prices. Prices going up isn't really inflation per se. It's the consequence of inflation. So inflation is inflating the money supply, and then I mean, I don't go into great detail, but that includes credit, debt and credit, which immediately get turned into money. Otherwise, it's just no use, obviously. And to go back a little bit with your sort of, you were kind of alluding to, one key thing that shows you how semi-independent the Fed kind of is, and I mean, it doesn't guarantee this, obviously, but obviously Janet Yellen was the head of the Fed for quite some time. And then now she's the head of Treasury. And, the Fed and Treasury, regardless of administration, interact quite heavily, obviously, particularly in the era of quantitative easing. But they always have interacted a fair bit, throughout history, but they've really interacted a lot in quantitative easing because it's obviously, given, as you mentioned, sort of, it's heavily tied up with sort of government bonds and whatnot, and getting out sort of the stimulus as well more recently.
Yeah.
Under both administrations, obviously Trump, and even, I would say even more so, it looks like there's a lot more sort of, if you like, money printing, if you, to use a kind of a sort of catch-all term. And that's what stuck out was, there's three measures that the US use of money supply. It's M0, M1, and M2. They obviously have technical definitions, and but the one, just looking at the statistic, was the M1 that kind of stood out the most, at least for this year. In last year, as you kindly pointed out to me, there was a statistical revision of M1 in particular last year. So obviously that impacts things, not just last year, but flows through a bit to this year. But I think even in that context, M1 kind of stood out this year.
Okay, I can put some charts in the show notes because I think you do raise an important point. There's been this huge increase in money supply. I mean, massive, that we haven't seen in decades, really. I just want to quickly,
even by QE standards, which QE is a previously massive increase in money supply, and yet we have something new, which I go on later in my article to connect it to this new idea. Well, sort of new idea of modern monetary theory, or MMT.
Okay, yes, definitely want to come to MMT. I just want to ask quickly about the Treasury and the Federal Reserve. I think that's a very good point you make about the fact that Yellen was previously in the Fed and now she's head of Treasury. So there must be a a lot of movement between the Fed and the Treasury. I know there's a bit of movement between the Treasury and Wall Street, but now also it seems
It's
between
actually
the
all
Fed.
three. All three, they kind of circulate. Yeah, yeah.
Oh, right. Okay.
Yeah.
So they're
And
both
it's
in
only
DC.
certain bits of Wall Street. It's the really big banks, like as the joke goes around the U.S., government Sachs instead of Goldman Sachs.
So you-
Um,
yeah. So you've spent time in DC. I haven't. So a Treasury and the Fed, are they near each other in the center of DC there?
um, yeah, they're not very far away from each other. Yeah, they're pretty close. You could easily walk, like a little stroll from one to the other. Yeah.
Treasury's not far from the White House, is it? I'm just trying to picture it in my mind. They've just from the maps I've seen.
The Fed's actually closer to the EPA, but it's not very far from the Treasury, though. Yeah,
Right.
Treasury's right next door to the White House.
Mm. Yeah, yeah.
But the Fed's, if not walking distance, it's like two metro stops away, train.
Yeah.
So
So,
it's close.
yeah.
And obviously, the executives, have access to chauffeured cars and all that sort of stuff. So it's pretty easy to get back and forth.
Nice, nice. Okay. So,
Well, a camera's similar, yeah.
oh, except I guess the ministers have access to chauffeured cars. I guess, yeah. So the senior executive in the Treasury or in the federal government agencies in the US, because they're appointed by the president, are effectively ministers, aren't they? Yes. Anyway,
Well,
that was a bit of a,
they're almost like ministerial staff. Yeah.
Right.
Yeah.
That was a bit of a tangent of mine. Just fascinated by this. Yeah, the linkages between all of these different organisations. Okay, back to MMT. Now, this Biden stimulus is pretty big, isn't it? And this is what is causing some concerns in the markets. Is that right, Darren?
Well, look, it's hard to obviously summarize, what the markets like or don't like, because, any sort of government intervention in the market, just by its definition, creates winners and losers. So, there's plenty of people in the markets who are winners, who are quite happy with it. It just really depends. Obviously who's getting it, how much it is, and how quickly it gets out there. So yeah, it's pretty hard to summarize that, the markets, you can say that they're all concerned, but certainly sort of the more conservative or libertarian oriented institutions have concerns, whereas obviously the progressive, more socialist oriented ones do not.
Okay, I'm just trying to think about what happened with the bond market. I might put a chart of that in the show notes, because we have seen some increase in yields of the of Treasury bonds over 2021, and that is reflecting in part concerns about future inflation. So inflation expectations are starting to get priced into bonds, but I mean, interest rates are still extremely low. So the 10-year Treasury yield, based on this chart I'm looking at, it's between 1.5% and 1.75%, it looks like. So I'll put that chart in the show notes. So I guess,
but look, regardless of what happens, that's an indicator, obviously, and obviously it's a fairly common and sometimes it's a useful one. Sometimes it leads you astray. So obviously, if that was a solid indicator that you could always rely on to predict the future, we would never have booms and busts. We certainly wouldn't have any busts, and people wouldn't be surprised by them. But they are. They always are. In fact, there's only a handful of people who will claim afterwards that they predicted it.
Oh, look, yeah.
Yeah, so obviously look at that sort of stuff, but just you don't even need to look at the statistics when you're beyond the first statistic you really need to look at is the money supply related statistics, obviously with the appropriate caveats of what exactly are they defining it, putting in there, and what's in and what's out. And obviously last year, what did they change? What did they put in? What they put it out? But overall, that's your leading indicator really for inflation, because it's always been the leading indicator that even sort of economists like Milton Friedman would point out, him and I forgot the name of the other person who did that major study of sort of money, for over the course of like 2 or more centuries. always found that every single time that any sort of sustained and significant inflation comes around, it's always to do with manipulation of the money supply. Well, increasing to be accurate.
So you're referring, of course, to the classic 1963 study for the NBER, A Monetary History of the United States, Milton Friedman and Anna Schwartz.
That's right.
We'll link to that in the show notes. Absolute classic. I guess one of the points that, Friedman's points are that inflation is always and everywhere a monetary phenomenon. So you can't have high, excessive and continued inflation without an accompanying expansion of the money supply, which is essentially facilitating that inflation. But he also makes the point that in the short run, the linkage may not be that strong. Like in the long run, there's a strong impact. But in the short run, there are quite a variety of things that can affect the level of prices. And so what the MMTers will argue, so the modern monetary theory people who basically say, don't worry about the deficit, don't worry about the debt. If you're a monetary sovereign, so to speak, you can simply print your own money and you can pay back the bondholders when you need to, or you may not even have to worry about that. The Federal Reserve should just give the Treasury a huge overdraft. Don't worry about selling bonds or whatever. So I think that's I've struggled to exactly figure out exactly what they're saying, but basically they're saying, don't worry about the debt. You just print whatever money you like. I mean, their argument is that the economy there's such slack in the economy. We're so far away from full employment that they can just print all of this extra money to help stimulate economic activity, and it's not going to show up in inflation. What are your thoughts on that, Darren?
Well, it's actually worse than that. That would be kind of at least some sort of Keynesian argument, but even Keynesians or at least former Keynesians like Paul Krugman are critics of MMT.
Yeah.
So the MMT is worse. They're taking, like, for instance, the Keynesian sort of the kind of macro income expenditure model. The C plus S plus T. That, and then they're going like, oh look, government expenditure minus tax equals, they kind of do the algebra and they go, oh, look, G minus T equals S minus I. Oh, but they don't think about causality. They go, well, oh, government deficits create, private savings, net private savings. It's actually the other way around. Obviously net private savings don't create government budget deficits, but they certainly help you to have one, in terms of if you're not going to simply print money, obviously, if you can actually draw down some savings too out of investment markets. And, obviously this is all kind of mixed together because, there's some real savings out there as well as just the kind of the printed money, if you like. So MMT is far worse than, suggesting that, oh, things are slow and thus we need to use it. These people are, pushing this thing as a kind of permanent model, or at least until CPI looks so scary that they get, at least a revolt from markets, or worse, a revolt from voters.
Look, I think they've aligned themselves with this view that we're in this period of secular stagnation. So yes, possibly they are putting.
No, I'm suggesting that they're not talking about. They're just some will use it as just a side argument, but no, they want this as this is the way you run government, generally speaking. It's not oh, we're in a recession, we need to do something about it. It's like, we think government should run more things.
Yeah.
Thus, the best way to do it is, if we can't raise taxes, because of Congress gets in the way, or politics, etc. We'll just print it. We'll funnel that through a complex system and make it look like we're not just simply printing it, but that's essentially what they're doing.
Oh, yes. Okay. So there's certainly a political aspect to it, because this MMT theory is its prominent supporters are on the progressive side of US politics, such as the US Congresswoman AOC, Alexandria Ocasio-Cortez, and some other, and I suppose, or Bernie Sanders. I think it was one of Bernie Sanders' advisors, Stephanie Kelton, who wrote that book on the deficit myth. So yes, certainly it's politically convenient.
So it's
Right.
for people further to the left than Krugman. So,
Mm.
that kind of context is kind of important. At least Krugman, I'm guessing, at least tries to stay within some sort of bounds of a Keynesian framework. And he sees as MMT as outside that.
Right. Yes. Yes. I mean, one of the concerns I've had about MMT is that by following this policy, you'd actually undermine the phenomenon that you're relying on. I mean, there's no doubt that governments can get away with a lot because they do have they can effectively control the money supply. But my view has always been, if you push that too far, then no one's going to trust your currency. Okay, so you could just completely. What's the line that Keynes quotes from?
Debauch the currency.
Yeah, debauch the currency.
How do you pronounce it? Or no?
Yeah, I think yes. So he said that's the surest way to create political chaos, and that's just where I see this.
Well,
going.
Lenin also said something similar, but in a way that he thought that was good. In other words, you're basically 90% of the way of getting a socialist system in place by this sort of process.
Yes, yeah, I guess, and Keynes, of course, would obviously be appalled by that. I mean, Keynes was about. I think Keynes wanted to socialize part of investment, didn't he? But he certainly wasn't a socialist. He certainly wasn't. He was a very. He probably wanted to maintain the existing system that he benefited from a lot. But that's probably getting a bit off topic.
But he did make a lot of money, I understand,
yes,
on the stock markets and stuff. So, yeah, I think it wouldn't be too much of a stretch to suggest Keynes, could have been characterized as a Fabian socialist.
Yes,
which means a long march towards it. But that way he can stay rich and eat nice things and go to nice restaurants in the meantime. Whereas obviously Lenin wanted overnight revolution.
Now the big controversy about Keynes as an investor. Now I saw a book that's come out. It was on the shelves at Dimick, so I still have to read it. So maybe I shouldn't criticize it without reading it. But it's about how Keynes was a genius as an investor. But from what I understand, there's this big controversy over the extent to which Keynes relied upon information he gained while working as a consultant to the HM Treasury. So to the UK Treasury, there's an argument that he actually used that information to make favourable stock trades, which...
That's why he was such a genius, was he?
Apparently. Well, because he did it for the Cambridge, the trust of the college he was at Cambridge, was it King's College? So, and he probably, I think he made some of his own investments too. So I think he probably saw it in service of the greater good.
Probably did.
Anyway, well, I'll look more into that. It's a fascinating story, but it sounds plausible though. I mean, if you're in a prominent position like that and you're an advisor to the Treasury and you're in contact with all the prominent people, even Churchill, then certainly that was a possibility.
I wonder if you had to give a cut to his version of the big guy.
I don't think so.
If your listeners know what I'm talking about, I'm not sure.
I don't think so. Certainly not to Churchill. I think Churchill was probably above criticism. He's one of the cleanest. I think he's one of the cleanest politicians we've ever seen. I mean, this is a point Boris Johnson made in his book on the Churchill factor, that Churchill's whole career, as distinct from a lot of politicians, there wasn't a lot of scandal. Like, there were some huge political stuff-ups, okay? He made some big errors. He got the big thing right in the end, but very little scandal.
Not so much in World War I, but yeah, made up for it in World War II.
Exactly. Yeah. Okay. So let's back to the inflation and money. Darren, we chatted before about gold, and so gold is seen as a hedge against inflation. Increasingly, crypto and Bitcoin have been seen as a hedge against inflation. But now, I mean, Bitcoin's just going all over the place, and there was a bit of a crash recently because of some comments Elon Musk made on SNL. Do you have any thoughts on whether investing in gold or crypto, bearing in mind none of this is financial advice relevant to your individual circumstances? So just asking you in general terms, what do you think, or what do you think personally about gold and crypto without giving investment advice?
I think I've been saying, look, I certainly, as I've always said, I don't, I'm I'm sort of like very much an amateur with, understanding cryptocurrency. I sort of read a little bit about it. I keep a little bit of an eye on it. I'm not a gold expert, but I do know, a fair bit more about gold than I do about Bitcoin. And, nothing's changed. In fact, this has kind of solidified my view. So like, it's basically not a substitute for gold. It's not, digital currency is not like real physical gold. Real physical gold is very scarce. No matter how much money you pour into trying to find the stuff, you just don't find a whole lot of it, right? And it's why it's ended up being, prior to the fiat currency era, why pretty much almost every culture on the planet chose it as money, because it does retain its value, just because you can't flood it. The supply side just can't be flooded. It's just once in a while, obviously when the Spaniards came back from, the Americas, okay, that sometimes happens in his history, but that's pretty rare. And they paid for it. They got some inflation in Spain at the time, but then it settled back down. They can't keep it going. They couldn't go in and find another 2 continents to conquer. That was it, that people didn't know about. So look, yeah, gold is by far the best hedge. Sometimes you can actually make some money out of it, but that's usually in times of monetary chaos. We are in one of those times of monetary chaos. I'm not suggesting go buy gold because it's going to go up for sure, because we don't know, because the supply side of that market is very set. Not much comes onto the supply. All the gold that's there, we're talking like 90+% has been there for a long, 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 long time, right? So, so it's really the demand side, and the demand side is driven by things like, am I worried about the currency? Am I worried about other investments, et cetera, et cetera? So, it's the demand side, and that can be a bit wild. So, it doesn't go back. So it's always pretty safe in the sense of, if you buy some gold, it's probably not going to crash on you, right? But I can't guarantee it's going to skyrocket, like it did a little bit last year. You remember there was the kind of that period where it was kind of skyrocketing. Not skyrocketing like crypto was. So crypto to me is kind of a more risky investment. I appreciate the fact that, many claim that Bitcoin was meant to copy gold, the concept of gold, and try to get around the fact that there was a lot of impediments to gold, either just because of the way the marketplace works, but also government impediments to gold as well. And also the fact, look, government can influence. I should put another caveat with gold. I understand central banks control, and I wrote about this for the Good Sauce, so I actually quoted the exact statistics, so I can't remember, but it's, something like 20%, right? That central banks own of the supply of gold. So obviously they can influence the market with that sort of number. It's not like 80%, so that's good. Although again, that's comes with another caveat of we don't really know for sure how much the central banks have, particularly the Federal Reserve, which is the most mysterious one. What's in Fort Knox, what's not in Fort Knox. Who knows?
Well, isn't it in Manhattan? I mean, you've seen Die Hard 3, haven't you? Remember?
Oh, okay.
Jeremy
I might
Irons?
relate it back to Captain America or something, but no, it's Die Hard 3, is it?
Oh, Die Hard 3, because remember Jeremy Irons' character, he was related to Hans Gruber, wasn't he? And in who was the villain in Die Hard 1, and then Jeremy Irons' character, they robbed the Federal Reserve Bank of New York, and they try to steal all the gold in the vaults. And he says that this is the biggest collection of gold in the world. Fort Knox is for tourists. So anyway, if you haven't seen Die Hard 3, totally recommend it.
I loved the first one, but that was I was never excited to watch any of the other ones.
The first one was the best. Yes,
Yeah.
there's no Godfather Part 2 thing going on with Die Hard, that's for sure.
Well, I think Godfather 1 and 2 were good, and then it's the third one that kind of gets panned a bit. So apparently, so the central banks own, according to some estimates, it's more like 16, 17%. So yeah, of the total stock. So it's influential, but it's not, they're not dominating the market as such, depending on your definition, of course. So yeah, look, cryptocurrency, it's an interesting thing. Always have high hopes that it might actually become a currency, because it certainly isn't a currency when it costs 40,000, or even though it's now down to 30,000 or whatever per Bitcoin. That's not a currency, obviously. And gold obviously isn't functioning as a currency either at the moment. It's more, as we talked about, kind of more a hedge investment. Not to say, look, gold certainly has the capacity to be a currency again, if that, if certain things happen, of course, and there was a sensible transition back to it. Whether crypto will actually be a currency, obviously Elon Musk and others are kind of looking at it as maybe doing that, but it hasn't.
Well, I guess the problem with Bitcoin now is that, like, Elon Musk was saying, well, we'll accept it for Tesla. And then he said, oh, actually, we won't. Because you just can't. I think that was the problem. You can't fix. You'd be mad if you said, oh, well, we will sell this car for X Bitcoin, and we'll keep that price constant for the next 6 months or something or whatever, because you just wouldn't do that because it's so volatile. So you're just not going to get any prices set in Bitcoin, any firm prices, any contracts set in Bitcoin. You'd be absolutely crazy. And so therefore you probably won't see it transitioning to be a currency in my view. But one thing I'm wondering, Darren, is because I know that you are a libertarian, and I know that Bitcoin is attractive to many, I guess, libertarians or anarchists, because they see this as something that is this will survive the coming, demise of our current civilization, where we've just got this rampant money printing. I know that there are a lot of those concerns out there. So could you see where they're coming from? I mean, I think they're probably I think they're overreacting. I can't see Bitcoin as I think there certainly are issues with all of the huge growth in money supply, and we could see future inflation. So we do have to be concerned about that. I'm less worried about breakdown of civilization, but do you see people like that? Do you know people like that who are worried about that?
Yeah, look, I'm a strange hybrid. I'm kind of in between a conservative and a libertarian, aspects of both. In some things I fit in one side, and some things I fit on the other side. But yeah, I know the libertarian world, and certainly the anarcho-capitalist world as well. And yeah, I think that a lot of them had kind of unrealistic hopes about cryptocurrency, and to the extent it really would become a currency that could eventually replace the fiat currency we have, or at least be a sort of like practical alternative, at least. It hasn't even become the practical alternative, really. It's an investment vehicle, but it's a risky investment vehicle, and that's fine, not saying that could never happen, but probably, sadly, the thing that they would want the least is probably more likely. In other words, the central banks will actually issue their own cryptocurrency.
These digital currencies.
It's not what libertarians, it's certainly not anarcho-capitalist libertarians want. And I'm, as a conservative, I share the concerns about central banks. That hasn't changed. And I do worry about the breakdown of civilization. I'm not saying it is. You're going to break down to the point of, what happened to Rome, obviously, for instance. But it could. I'm not of that sort of conservative camp who go, oh, this could never happen. Oh, we're run by the rule of law. After 2020, we're not run by the rule of law. That is quite clear. No Western society really has a strict rule of law. Basically, officials and bureaucrats can largely do what they want, and courts will largely rubber stamp it. Particularly if there's a crisis like a pandemic going on.
Yes, yeah. Look, I've certainly been surprised by the extent to which governments have gone beyond what we thought traditionally they could do. I know you can make arguments in the public interest for some of these measures, but look, I wasn't. I know that you were someone who was, as soon as this was all occurring, you were sounding the alarm bells, whereas I was probably a bit less worried about it. But yeah, certainly I'm coming more to your point of view. So I think that's a good point. We'll have to chat about that in another episode, Darren.
Well, it's related because, you know, even as I point out in my you know, all this kind of MMT, which, you know, 2 years ago would have been crazy, you know, like that's got no
Yes.
chance. You know, it's back, it's on the table because of 2020, because of the lockdowns, because of, you know, all the other stuff that happened, you know, the BLM, Antifa, all this sort of stuff. Everything's on the table, sadly. So, you know, obviously it's not the focus of my article or our discussion, but culture and economics are not two completely separate things. And civilization as a whole, you know, is both of those things, if you like, and more. And, you know, sort of there's governments who are playing with fire and institutions, central banks that are playing with fire. You know, Federal Reserve and the Reserve Bank are being completely irresponsible.
Right. I mean, I guess you talked about the linkages with progressive politics before in the US. Well, it's not just so-called progressives. It's actually, if you look at what's happening in Australia too. I mean, you look at the huge budget deficits we're running and the large growth in money supply because the RBA here, the Reserve Bank, it's doing its own quantitative easing. I mean, we're sort of going that way too, which has stunned many people in Australia. I mean, certainly some emergency measures were required, but yeah, just what's being done now is striking some of us at least as quite excessive. And we have a nominally a conservative government in Australia, or the Liberal Party and the National Party, although the Liberal Party here is supposed to be conservative. Looking at its budgetary policy, you just wouldn't recognise it. You wouldn't think that this was the party of John Howard and Peter Costello, which ran 10 budget surpluses. It's
No,
just
no, not at all. It's very disappointing. It's disappointing on steroids in many ways. Like I criticized, you know, the 2017 budget. You know, I had a close look at that at the time, and ScoMo was treasurer then, and I just thought it was just an absolute terrible budget. Of course, you know, I thought, oh well, that's because, you know, Turnbull was the prime minister. So, you know, let's see how ScoMo goes. Obviously, he's not, you know, the budget is Frydenberg technically, but obviously the prime minister and treasurer have to work hand in hand on this. Treasurer's not going to just do whatever they want, obviously. Just like obviously Costello and Howard worked together, Keating and Hawke in a previous period. Yeah, things have, you know, not obviously have been changing certainly for like the past 10, 12 or so years. You know, GFC really, you know, because, you know, a lot of us, you know, I don't know about you, but I thought Keynesian economics was dead, yeah, for the most part.
I
And
would
then,
have until 2008-09. Yes,
yeah,
yes,
all of a sudden,
yes.
oh, it's not. You know,
Yeah.
so in 2020, 2021 is, you know, like, you know, it's moved beyond Keynesian economics. It's, you know, as I said, it's this MMT philosophy. And it ties up with, you know, the philosophies of, you know, it's not directly linked to, you know, things like cultural Marxism and postmodernism, but they work quite nicely hand in hand, to be honest. They're, you know, it's in many ways, it's a kind of a new unholy trinity that we're seeing in the US, and I'm sure you're going to see it in Australia very soon, if it's not already there. Well, I know it's already there. These sort of forces are already there, but, you know, under the kind of very small c conservative government, maybe it's held back a little bit, but, you know, not that much really. You know, the liberal nationals have a, you know, have certainly a great track record over the past 12, 15 years of capitulating to the left. So yeah.
Well, I guess there's been a general shift in public attitudes in a leftward direction, and to an extent, the party on the right has decided to shift with that for political reasons. I mean, that's possibly what's happened.
Yeah, that's the assertion, but as we all know, the polling can be out by like 15+%. So it's hard to say what's going on. I don't think the public has really lurched way off to the left, supporting critical race theory, the Great Reset, MMT. I don't think so. I think, if people really understood these things, the left have always operated in a fog. They don't sit and put their cards, clearly on the table. For every Bernie or AOC, there's another 10 or so people behind the scenes who say, oh, we're doing the exact opposite. Oh, we're not doing this. So, and that's common throughout the Western world. The interesting thing about Australians always think there's such a chasm between what, the US culture and the, no, there isn't. It's minimal. It's very minimal. I've lived and operated across the English speaking world. I see the exact same phenomenon. Just, maybe one's leaping ahead a little bit over the other, but it's all, it's the same sort of like political and worldview divide. And then, it sets up the exact same way in terms of big inner cities versus everybody else. It's the same thing, US, Australia, Canada, UK.
Well, there's certainly that big inner city versus regional divide in Australia, except on the issue of
the burbs too.
Yeah.
The outer burbs tend to be more conservative, obviously, than the inner burbs. So it's kind of, I think it's kind of inner city elites versus the rest for the most part.
Well, why don't we return to this in a future conversation? Because what I'd like to explore there is the big issue in Australia, other than COVID. I mean, COVID is obviously a huge issue, but climate change, and then that is creating conflict between people in the inner city who would prefer rapid decarbonisation of the economy versus people in some regions where the regions are highly dependent upon coal mining. So I think that would be a good topic for the future. Before we wrap up, Darren, I'd just like to ask you about the 2017 budget. So was this when you were an advisor to Senator Malcolm Roberts, the senator here from Queensland?
Yeah, that's right. Yep.
Okay.
So I sat in that is it the lockdown or whatever they call it.
The lockup. Budget lockup. Yeah, I've administered one of those before.
Sorry.
Yes.
2020 is in my head. Lockdown. So yeah, there's a lockup. So obviously, I prefer that lockup to the lockdowns.
We only lock you up. I think we only locked you up for a few hours, didn't we? This is for the budget. The journos and advisors get the budget in advance of it being handed down in the Parliament at 7:30 that night.
And there was plenty of bad coffee and bad snacks, so it was okay. So yeah, I did that analysis for the senator, and then I had that all in my head. And then, later on, just wrote it also for Liberty Works.
Before you go, I'd like you to tell us about this interesting exchange that your senator had with the then Secretary to the Treasury, John Fraser, the Secretary to the Australian Treasury. And John Fraser was a former global chairman of UBS or something like that. Like he was a very prominent banker. And Tony Abbott invited him back to be Treasury Secretary in Australia. And your senator, and this relates to our topic of inflation and money, your senator had an interesting exchange with John Fraser. And I think this exchange was probably prompted by some work you had done for the senator, wasn't it? Could you tell us that story, please, Darren?
Do you have the quote in front of you?
I should have it somewhere. Yes.
Because if you like, I can do Senator Roberts' part. You can be Secretary Fraser if you like.
Okay, I'm not sure I could. Let's just see Fraser. Yeah.
Well, I'll just read it to you anyway. I won't forget the voices. I can't do other people's voices anyway. So so Senator Roberts asked a question in budget estimates in May 2017, and he goes, "Isn't it the case that such money supply inflation has been the key driver, at least on the demand side of the economy, of the rising consumer price index in recent decades?" Then Secretary Fraser said, "It is a hard one. I do not have an answer. I'm a traditionalist, so I see money base growing like this, and it worries me. But every time I carry on and talk about the inflationary impact, everybody laughs and says, "You're showing your age," which I am. That is a non-answer, but it is interesting. And I know that a lot of the people in treasuries around the world look at it and say the same thing. We do not have an answer. I'm not sure if that's really true. I think they know what's going on behind the scenes. To what extent Secretary Fraser was, he sounded like he was kind of putting the, I don't know him. So, he sounded like he was being fairly, he seemed like he was being honest in what he was having to say. Because, he could have easily just dodged that question, with a typical sort of Treasury answer. So, it was kind of interesting, that, he's kind of was worried. And he should be, because,
Yes.
it's not good.
I guess the thing, the one point that we ought to cover before we wrap up, it's this point about how, well, we've seen this, quite strong growth in money supply. It's not necessarily shown up in CPI and consumer price index inflation yet, although you're arguing that the most recent inflation data in the US suggests that it's coming. But it has shown up in asset prices, hasn't it? So it's shown up in house prices, it's shown up in stock prices. So they've been elevated by all of this money that's been available. Yeah.
Real estate, depending on where it is, obviously real estate's location. But the stock market, real estate are just, two traditional areas where, you get, that kind of bubble forming to some extent. Then, sometimes here and there, mining can be, or other sort of really capital intensive industries, obviously, because obviously at low interest rates, you need a lot of money, et cetera. But real estate and stock markets are the classic places. That's where it showed up in the 1920s, when there was also a money supply driven inflationary boom then as well. Because the Federal Reserve started in 1913. Obviously, there was World War I, inflated like wounded soldiers, drunken sailors. I think the term is not wounded soldiers. Sorry,
spent like drunken sailors. Is that what you're saying?
Yeah, sorry. I'm mixing metaphors together there, like Sir Joe Bielke Peterson or something. But yeah, so look, and then obviously, the 1920s had some genuine, real economic growth because the Coolidge administration did great stuff with low taxes and low regulations and all that sort of stuff, and getting out of the way of business. But one thing they didn't do well, and I kind of forgive them a little bit because it's the first time the U.S. ever had a central bank for any length of time. Not the first time they've ever had them. They've had a 2 or 3 in the 19th century. And so, look, they probably didn't know what was going on. They didn't fully understand the ramifications of what the Federal Reserve was doing. But of course, what the Federal Reserve did in the 1920s is nothing compared to what they've been doing since, 2008, et cetera. And, what I argue, obviously, in my article, what they seem to be doing since January 20th, essentially, to that date, they've started to take, not just, they've moved on from the QE philosophy to the MMT philosophy, I believe.
And I think that's what's different now, isn't it?
Protestations to the contrary, I think, hopefully she's smart enough to go like, oh, I'm concerned about this, but I work, my boss is really, the president this time. He wasn't technically the boss when she was the head of the Federal Reserve, even though she's appointed by the president. She obviously works for the president this time as Secretary of Treasury.
Yeah. So what's potentially different now from what we had from the GFC and the years after the GFC, where we had the quantitative easing? Now we've got potentially massive deficits, massive stimulus ongoing associated with strong growth in money supply. Arguably, you could say this is a type of MMT, and that therefore we could start to see inflation not just in these asset markets. We could start to see it spilling over into consumer prices.
Yeah,
would that be fair?
Yes, you always see it spilling over in CPI. When people look at CPI in teeny little segments, you can go like, you can explain it away and say, look, there's nothing going on here. But it takes about 2 seconds to go look at what CPI looks like over the course of years and decades, and you go, whoa, That's a scary picture by itself. And CPI only, there's no exact estimate, but it's about 40% of the economy. So there's another 60% of the economy that's not being captured by CPI. And if CPI looks scary in that 40%, and I argue that it does, I'm not talking about just the 4.2% last month. Look at it over the course of decades. It's not a pretty picture since the mid 70s, and it's been worse, obviously, the past 10 years or so. And then, yeah, obviously factor in, well, okay, that's only 40% of the economy. What about the rest of it? Okay, let's look at asset prices, wholesale prices, wages, et cetera, et cetera. And what's also different is QE, at least, in principle, and maybe in fact too, was aimed at stimulating the private sector. This one is really stimulating the public sector. And those associated with the public sector, like unions and activist groups. It's, I mean, this money.
Well, how's that, Darren? I mean,
it's like, it flows to, eventually it's flowing to places like, like I said, activist groups and teacher public sector unions and all that sort of stuff. They're not trying to, if they want to stimulate the economy, get rid of the lockdowns. I mean, that'll stimulate the economy pretty quickly without you needing to throw taxpayers' money at it. So they're stimulating other stuff. And they're stimulating welfare checks. Because, okay, you say, even if you're on the left, you think, well, we have to have these lockdowns. Okay, well, that still means people are unemployed. So, this money is going into welfare. It's going into unions. It's going into activist groups. It's going into, obviously, when it hits Wall Street, like it always does, it flows first into the best connected people in Wall Street. So that's big tech, all that sort of stuff. Sporting leagues, a lot of frivolous stuff, right? It's not hitting Main Street particularly quickly.
Right. Okay. Gee, yeah. Lots of issues to think about, Darren. Just
on that, it's very regressive. So like when people this sort of money, it doesn't just hit everybody equally. It doesn't. Lots of people win out of this. And if everybody was hurt a lot quickly, such a policy wouldn't. You move away from it very quickly, right?
Yeah. Just on the increase in CPI since the 70s, look, there's no doubt that we had high inflation. Well, there was very high inflation in the 70s and the 80s, and then it got under control for a period, and it's been relatively low for the last, 20 years, at least 20 years or so, and then now there's risk that it could increase. But I'm struggling to see why it matters.
That's the mainstream narrative. Just look at the graph. Look at chart 2, which is just basically U.S. CPI. And you can do the same for Australia. I've done it.
Yeah, but
you look. It's not that narrative you just said. Actually, isn't the case.
But our wages and prices our wages and incomes are higher in nominal terms as well as the price level is higher. So,
well, look, yeah, you're right. You have to obviously compare. Ultimately, you have to look at that too, and other factors as well. But certainly, just the straight up narrative that you lay down, which is it's a pretty standard narrative. It's not like you invented it. It just I've heard it dozens of times. That it just isn't true by looking at the CPI. I mean, the CPI certainly in sort of the mid 70s to the late 70s had an uptick that certainly stood out. Obviously, given what preceded it, and then there was a little bit of a flattening off in the 80s, under Volcker, for instance. But then there's just been kind of this steady climb that really is not good, and then it gets obviously from GFC onwards. There's a little bit more of a climb, and and obviously we'll see what happens. Obviously, we've only had the Biden administration in power for 4 months or whatever.
Okay.
There's been kind of a significant uptick, on top of the uptick from 2008, which was already an uptick on what was going on, kind of in the 90s onwards. But yes, of course, you have to ultimately compare it back to wages, profits, and various things to to see whether. But the fact is, this process, you're just not going to have everybody's wages aren't going to all go up, and at the same time, and our entrepreneurs are going to have profits that go up at the same time to match this inflation. There's winners and losers, which
yeah, absolutely.
under the previous system you had less of that.
Yeah.
Even though the gold standard was very imperfect, from sort of the 1930s through to 1971, you can see at least CPI, is fairly, it's kind of the monetarist view of the world, kind of just a small increase, here and there, as time goes on. That's not been the case, so, referring back to Friedman again, it's a fantasy world that he thinks that central banks can be kept under control, because they certainly haven't very much, except for one period in the 80s under Volcker, under one guy.
Yeah. So Friedman wanted an act of Congress, didn't he, to force the Federal Reserve to grow the money supply at a constant rate per annum. Was that?
Well, there was like a bands, kind
Yeah.
of a band that that they could operate within.
But
which
what?
is obviously much smaller than what we've been seeing, since that time period.
Yeah, but what central banks have been doing since the 90s, they've been targeting inflation, and originally, I mean, inflation was higher than the target, and so they wanted to get inflation down to 2% in the US, so that the target of 2%, in Australia 2 to 3%. But at times now, in the last couple of decades, it's been below that, and there's been this idea that, we've actually got to get inflation back up to, we've got to push it back up toward the target, which is it's a fascinating development.
Well, 2 to 3% is still, it's irresponsible. I mean, that's, when we talk about, like how 2 and 3%, economic growth can be good and accumulate in a good way, like interest. Well, that's exactly what CPI does as well, but in the negative sense. When you start like I said, you have to. I mean, yes, you look at kind of recent CPI stats, but you always have to then kind of look at, okay, what does this look like over a longer time period? For instance, I looked at, I've looked at this more recently, but like when I was working for Senator Roberts, I would always sort of get these graphs sort of ready for him that he could use in various ways in Parliament or interviews, whatnot. And I was shocked too the first time I actually just kind of looked at Aussie CPI over a length of period, rather than just like kind of the past year, the past few months or something like that, where these arguments, no, it doesn't seem like it's, it seems like it's fairly under control. But then you look at it over a time period and you go, what? Like for instance, in Australia, you can see, particularly from the early 2000s onwards, it's like, what is going on? CPI is growing at a pretty hefty pace and consistently.
Well, we had a period of.
So that's not GFC. Sure, yeah, GFC. They, then kind of adds a bit more to it. But there's, the only period. If you look at Aussie CPI, it's actually a scarier picture than the US, to be honest, because CPI in Australia starts kind of going like, well, it starts going crazy slightly earlier than it did in the US. So it's kind of the early 70s. It starts taking off rather than the mid 70s. And then, it keeps on doing that really until sort of the economic reforms of the mid 80s, the sort of Hawke-Keating sort of reforms through the national competition reforms in the 90s. And then, CPI is kind of, it's still growing, but it's, you can see that it's kind of flattened out a little bit, at least, the growth. But then, after that, it's, from the 2000s, the early 2000s onwards, it's looking a little bit like the 70s again.
Oh, well, I guess in the lead up to the GFC, we had the mining boom, Mark 1 of the mining boom, and there was high wages growth, and there was some inflation before that.
Well, this is just CPI, so
yeah,
obviously they interact, but there's obviously wages and asset prices are separate sort of measures. I mean, obviously they probably bleed into each other, but they're not exactly the same thing. I'm just talking purely CPI. So you have so the narrative that it's all okay, and there was there's these large periods of it was pretty good. isn't actually correct. The only period where you can really say, like for instance in Australia, where it's good, is to actually, I actually mentioned the mid '80s reforms. It's more they, when they combined with the '90s reforms, then you got kind of a nice, flattening off in the '90s for Australia, but then it grows again. So you have a bad period, early '70s to the end of the '80s, and then early 2000s through to today. It's not good.
Yeah.
That's there's just no way that obviously, again, you have to qualify it, look at what wages is doing, look at kind of wholesale prices, asset prices, the whole thing. But it certainly falsifies the narrative. The standard narrative about CPI has been largely under control. No, it hasn't been.
Well, I guess it depends on what you mean by under control. So what the mainstream economists would say, and what I'd say the majority of economists would say, and is that, well, if you've got inflation running at only 2% or 2 to 3% per annum, then that is largely under control. Whereas you're arguing that you'd prefer to see essentially 0% inflation.
No, I'll look. I mean, you certainly make a good point. Obviously, we're using qualitative words to describe sort of quantitative concepts. So no, I'm talking even in the kind of the sort of the Friedmanite view of the world, right? Kind of the 1 to 2% type of sort of inflation growth, if you like, or CPI growth. I think Australia looks like they're outside those bounds from the early 2000s to today, and they look like they're outside those bounds from the early 70s through to the late 80s.
Yeah, well, I guess it depends on the time period you're looking over, but commentators would point to what's happened in the last few years in Australia, and they'd say, well, the RBA at times has not been meeting its inflation target, and therefore that's what's justifying all of this quantitative easing. That it justified cutting the cash rate to, what is it now, 0.1% or something? Extraordinary. And also all of this quantitative easing.
I have very little time for most mainstream commentators anyway. They don't seem to understand their subject, or they purposely give you not quite the right impression of what's going on. Because like I said, it doesn't take a genius to quickly look up, Australia's CPI or the US CPI over a longer period than the past 2 years or the past 2 months, just to go, wait, that doesn't look quite right. It certainly tells you right away that the narrative that inflation looks like it's under control. It's just not correct. The only thing you could argue is, oh, look, from a Chicago sort of point of view, it looked like it was under control in the '90s. From an Austrian point of view, no, it still looks like that's not that great. And I'd even challenge a Keynesian to kind of look at that and go, yeah, things look pretty good, before the '90s and after the '90s from a CPI perspective. I mean, maybe they might say that. But I'd at least challenge them to sort of like justify that looks like acceptable levels of inflation. I mean, you start pumping that into the economy, it's sticking. It's not like, oh, things change. You destroy wealth for the past 5 years. Now it's okay because we've printed a little less money.
Well, you've certainly eroded the value of money. If people are just holding, if they're just keeping their money in a bank account, then certainly any increases in prices is going to erode that value if they're not being compensated through the interest rate, and people aren't earning. Nowadays you don't really get interest payments on your bank accounts, or it's actually negligible. But if you're holding other assets such as shares or real estate, then they will increase along with the price level. And what we've seen is that they've actually been increasing more than CPI.
Yeah, but who except for the 1%ers? You have.
Well, that's the problem.
You got to, because ultimately you can't eat asset sort of like rises in your asset prices. Eventually, you have to turn them into money to do something. And that's the thing. What's so insidious about inflation and why it's driven by the money supply. Yes, prices are driven by all sorts of stuff, not just the money supply, but any sustained sort of increase, et cetera, is the money supply. Why is that? Because every single good and service, you're not trading it for another good and service as such. What are you trading for? Money. It's in every single transaction, including when you buy that asset or sell that asset, you're still dealing with the currency. So it impacts, virtually everybody all the time, except for maybe the 1%ers who yeah, they just have so much money that, yeah, the devaluation and the little amount of currency that they use, to buy caviar or whatever, it doesn't really affect them. But it impacts, everybody else, and businesses, consumers. It's just artificial. And, ultimately, anybody can, anytime you give someone a monopoly, it's usually abused. And this is, the central banks in a cartel arrangement with the big banks, like a legislative cartel arrangement, a legal one, it's completely legal, essentially have a monopoly over money and credit and every economy around the world.
Look, yep, true. And I think what we're seeing now
What
is
a
that
monopoly do,
the central banks are running a big macroeconomic policy experiment. And over the next few years, we're going to see if that experiment has what the results are. And yeah, there are good reasons to suspect that they may be undesirable. So yeah, Darren, we've covered so much today. Yeah, go ahead.
They have been running the experiment for like over 100 years, actually. And it gets worse and worse and worse and worse, with some good periods here and there. Like I mentioned, obviously Volcker era or something like that. But there's not many Volcker eras, to be honest. It's, the good era is usually the exception, not the rule, sadly.
Yeah, look, I think the level of experimentation now is, it's pretty extraordinary relative to what's happened in the past. Darren, Brady, Nelson, I think we better wrap up. We've covered so much. Every time I chat with you, I can think of, I don't know, at least half a dozen other topics I want to cover, or that we could explore in more depth. But I really enjoyed that. Was there anything else you wanted to say before we close?
Oh, no, look, yeah, I agree. Look, as an economist, and you're an economist as well, we're trained and to kind of see that there's lots of connections. There's first round effects, second round effects, third round. And then, as I kind of study beyond just economics, I start seeing the interconnections between economics and things that are supposedly not economics, you know what I mean? So, which is why I raised the various political issues like, sort of the Great Reset and critical race theory and all this sort of stuff. Because, I'm not saying they heavily overlap, but there is definitely overlaps.
That's fair enough. We can chat about that more in the future. Darren, Brady, Nelson, thanks so much again for your time. Really enjoyed it.
Thank you very much. Bye-bye.